All right, let's just jump right in. Welcome to The Explainer. Today, we're putting on our sell-side equity analyst hats to conduct a bit of a financial autopsy. And guys, it is a fascinating, completely contradictory set of metrics we're looking at today. The target, Datavault AI, traded under the ticker DVLT. Now, when we're doing fundamental valuation, we're obviously looking for a logical flow, right? Revenue drives earnings, earnings drive cash flow, and cash flow ultimately drives intrinsic value. But what happens when those numbers completely detach from reality? What happens when a stock literally breaks standard financial models? Well, that is exactly what we're going to unpack today. Negative 87.21%. Yeah, you heard that right. That is the massive plunge Datavault AI took from its 52-week high of $4.10 all the way down to a recent close of just 52 cents. In literally 1 year, almost 90% of the stock's peak value just vanished. Poof, gone. But as we're going to see, this wasn't just some sudden random market hiccup. This is the result of a much longer, much more painful structural trend. Consider this brutal historical destruction of shareholder value. When we look at the year-over-year returns from 2022 to the 2026 year-to-date, it paints a totally devastating picture. Down 92% in 2022, down almost 99% in 2023, down 88, then 68, and already down nearly 20% in 2026. String all those together, and you hit a staggering total return of negative 100% over a 5-year period. It is just a relentless erosion of equity. You're probably wondering, how on earth is a company with a track record like this even keeping the lights on? Well, that brings us to the central mystery of our analysis today. The revenue illusion, skyrocketing sales, vanishing value. So here's where the sheer scale of the contradiction really hits you. On one hand, you've got trailing 12 months, or TTM revenue growth, sitting at an absolutely mind-bending 1,361.82%. They raked in over $39 million in revenue. I mean, if you were only looking at that top-line growth, you'd think, wow, this is the hottest tech startup on the exchange, right? But then, reality hits. The TTM net income is a staggering negative $78.994 million. They aren't just failing to turn a profit on that explosive sales growth, they are hemorrhaging capital at a scale that completely dwarfs the revenue coming in. It's literally the ultimate top-line illusion. Profitability in free fall, tracing the cash bleed. Let's get under the hood. All right, brace yourselves, because these core profitability metrics are horrific. Return on invested capital, negative 12.85%. Basically, management is actively destroying value with the capital they deploy. Return on assets, negative 42.66. But the real jaw-dropper here is the net profit margin, a staggering negative 1,652.98%. Let's translate that into plain English. For every single dollar of revenue Datavault AI brings in, they are losing over $16.50. Their cost structure is so wildly disconnected from their pricing model that the faster they sell, the faster they dig their own grave. And here is what that catastrophic profit margin looks like in hard dollars. The trailing 12 months free cash flow is negative $23.99 million. They are quite literally setting piles of cash on fire to generate those record-breaking sales. This isn't a case of a company investing heavily upfront for future efficiencies, you know? This is a fundamentally broken business model with a structural leak that's draining cash way faster than they can ever pump it in. Valuation models break down when the math fails. This creates a massive headache for us as financial analysts. How do we calculate fair value for a company bleeding this much cash? When you sit down to produce a rigorous stock valuation, whether you're looking at relative models like sum of the parts and peer multiples or absolute models, you absolutely need a positive foundation to build on. So what happens when that foundation is completely missing? Think about standard relative valuation multiples for a second. The price-to-earnings ratio is negative 0.50. The price-to-free cash flow ratio, negative 8.36. The PEG ratio is negative 0.01. Guys, these metrics are completely useless here. You just can't derive a meaningful implied intrinsic value using median peer multiples when your denominator, the earnings or the cash flow, is deeply negative. It tells us they're losing money, sure, but it gives us absolutely zero insight into the intrinsic value per share. So relative valuation, dead end. Normally, a sell-side analyst would pivot to an absolute valuation model. The gold standard, of course, is the discounted cash flow, or DCF. You estimate expected future cash flows, derive your unlevered free cash flows, figure out your weighted average cost of capital, and discount it all back to a present value. It's rigorous, it's highly mathematical. But then you look at the actual output from the data source. DCF fair value price, NA. Literally not applicable. Why? Because you mathematically cannot discount a deeply negative trailing free cash flow of minus $24 million into a positive intrinsic value. Not unless you make massive, entirely unsupported assumptions about some miraculous overnight turnaround. When historical cash flows are missing and margins are negative 1,600%, the DCF model doesn't just struggle, it breaks. The math fails because the business fundamentals have failed.
A final reality check. The silver lining?
Okay, so are they closing their doors tomorrow? As impartial explainers, we have to look at the whole picture. And surprisingly, there is a tiny silver lining. The number, 5.32. That's Datavault AI's current ratio. Combine that with a quick ratio of 5.29, and it's actually kind of surprising. What it means is that despite the massive cash burn, they currently have over 5 times the liquid assets they need to cover their short-term liabilities. Plus, their debt-to-equity ratio is incredibly low at just 0.05, so they aren't drowning in debt payments. Essentially, they have short-term liquidity acting as life support. But let's be real. With a negative $24 million annual cash bleed, that liquidity is just a ticking clock. Which brings us to this perfect summary quote. A 100% 5-year loss paired with 1,361% revenue growth. That right there is the core contradiction of Datavault AI. It's a huge, flashing neon sign reminding us that growth does not equal value. You can scale your top line to the moon, but if your fundamental unit economics are unprofitable, you are literally just scaling your own destruction. So I'll leave you with this. If phenomenal top-line growth can't save a broken business model, what metric are you going to trust first in your next analysis? Are you going to chase the revenue, or are you going to follow the cash? Understanding the dynamic between those numbers is the absolute key to mastering fundamental valuation. Thanks so much for hanging out with me for this deep dive. Keep analyzing, keep asking the hard questions, and I'll catch you in the next explainer.